Let's continue our discussion on dividend discount model. Dividend discount models are based on present value concept in which we discount future cash flows. In case of DDM, the future cash flow is dividend until NTH value this goes, and this becomes the last value plus the expected sale price of share at that point in time divided by 1 plus, or this is cost of equity or rate of return raised to the power n. Estimating these future dividends till the nth year becomes really difficult. So we apply Gordon growth model here, which is basically dividend at this stage, which is 0 I'm taking. But this has to be d, let's say, multiplied by 1 plus g divided by r minus g, and this what we are saying is under Gordon growth model. First assumption is cost of equity has to be more than the growth. The second assumption is that the company pays out dividend. If a company doesn't pay out dividend or the company doesn't have a history of paying dividends, then this might not be the right model. Whatever is the future dividend, it will give us a perpetuity number here. We have the perpetuity number now. This will be a big number. Discount it by these numbers, and we'll get the present value here. So let's try and solve one question. We are given in this question is there is a stock XYZ, which recently paid $2, and its investors require a rate of return of 10% on its equity. Its dividends are also expected to grow at 25% per year for next 3 years, after which it is expected to grow at 5% in perpetuity. Calculate the value of XYZ stock. This is year 0. Then we have 1, 2, 3, 4. So what we are given here is the company recently paid $2 as their dividend. So this becomes D0. We are also given that the rate of return is 10%. And they say that dividend is expected to grow. We call it supernormal growth. It is 25% and our normal growth, or the growth in perpetuity, is 5%. Our supernormal growth is expected to be there for the next 3 years. We'll take D0, which is $2, and we multiply it by 1 plus the supernormal growth rate, that is 25%. We get 2.5 then. So, then we have 2.5 by 1 point plus 25%, and similarly we take 3.1 by 1.25, and that gives 3.9, and in the 4th year. This is a perpetuity year, so we change our growth to 5%. After this point, our growth basically is 5% and not 25%. This is our first step in the calculation. The current dividend can be easily found in the annual report. In any annual report, you'll find a dividend section. Under dividend section, you'll see that companies usually would report for the last 2 years as well as the current, and there would be a number directly mentioned, amount recognized as distribution to equity shareholders. So, in our case, after 3 years, we will apply 5% growth rate instead of 25% because the growth in perpetuity is expected to grow at 5%. In next video, we will move into the next steps.